Let's focus first on what's going on in the U.S. because you've recently put out a forecast of, I think, 4% growth in 2018, up from 3.7 in 17. Is this largely due to the new tax package that's just gotten through Congress?
Yeah, so that number refers to the global economy. As far as the U.S. is concerned, we're thinking 2.7 is our number for 2018. And that's also up about half a percentage point. So we've seen a pretty synchronized improvement, obviously at different rates, with places like China and India growing a lot more quickly than the advanced economies. Now, what are the drivers of growth in the U.S.? I would say two things. One is, and this is partly a backward-looking view, but I think it's still relevant in 2018, the change in the impulse from financial conditions. Financial conditions were a big drag on growth in 2015, early 16. It took a while before the market had digested the start of Fed rate increases, and that weighed on things, partly through the exchange rate. But that's really swung, and we've gone from probably an impact of minus 1 percentage point on growth from financial conditions to almost plus 1 percentage point. So that's 2 percentage points. And I think in 2018, given what's happened to financial conditions, how buoyant markets have been, we'll continue to see positive impulses, at least for the next few quarters. Second point is the one you mentioned, namely the fiscal expansion, the tax cut, the tax reform bill, which we think is going to contribute to growth in 2018, 2019. Probably not quite as powerful as financial conditions, but we think about 0.3 of a percentage point both this year and next year. And then on top of that, also related to it, we'll probably also have some spending increases. So overall, half a percentage point, give or take, growth contribution from fiscal policy seems like a reasonable estimate.
So you mentioned financial conditions in 2015. That was a time when the market was concerned that the U.S. economy may not be able to handle even a 50 basis point benchmark rate at the Fed. As we get to the end of 2018, people are expecting 2.25% from the Fed. Does that slow things down too much? Does that hurt financial conditions?
Well, I think that's the point to some degree, right? Monetary normalization, the idea is that you tighten financial conditions at least gradually, in order to slow things down gradually. I mean, that's not normally how it's presented, but I think that is the point. Now, so far, we haven't seen any of that, right? We've seen 125 basis points of rate increases, but nevertheless, financial conditions are a lot easier than they were at the start of this process. Over time, in 2018, 2019, yes, I would expect some of that to reverse. And ideally, it would reverse very gradually. You don't want, a very sudden, big tightening of financial conditions. But yeah, I mean, I think it's likely to go in that direction, primarily through the rate channel, both at the shorter end and at the longer end. We do expect some increases in interest rates.
How many?
And more than what's priced. So we have 4 hikes in 2018. Market's priced for 2. The median Federal Reserve projection in the dot plot is 3 hikes. So we're above that, basically because we think that the labor market is going to improve more quickly than what the Fed's projecting.
Do you expect the curve to completely flatten?
We do not. I mean, obviously it has flattened, and it makes sense that when the Fed delivers more rate hikes than what's priced in the markets, that you would get flattening. But in 2018, our expectation would be that there's also going to be some increase in the term premium at the longer end of the curve, so the curve stays kind of positively sloped. That's the expectation.
What about inflation, Jan? I mean, you're expecting then 2.7% in the U.S., basically trend growth. You've got 4% unemployment. Is the Phillips curve dead? Do we get a bounce in inflation after the slack comes out of the system?
Yeah, so I think we're at an above trend growth environment. Even if we just take the GDP numbers and let's say 2.7% turns out to be the right number, our estimate is that trend growth, potential growth, is about 175. So that's 1 percentage point above trend. Typically, by the usual rules of thumb, you would say that should push the unemployment rate down by about half a percentage point. I said even if we use the GDP numbers, if we look at other higher frequency indicators, which we summarize in our current activity indicator, those have actually been showing something closer to 3.5% or 4% growth. So I think we're clearly in an above-trend growth environment. Now, on your question on inflation, we think there is a Phillips curve, but it's very flat, and the numbers are such that the ups and downs of the labor market only account for some portion of the ups and downs of inflation. Just put some numbers on that. A 1 percentage point move in the unemployment rate, by our estimates, only gives you about 1 or 2 tenths of additional core inflation. 1 or 2 tenths is a small number. There are obviously lots of other factors that can overwhelm that, and that's what happened in the last year. I do think you probably got a little bit of a boost from a cyclically stronger economy, but there were a number of other things that went the other way. Rents were weaker. There were some changes in cell phone pricing, partly due to methodological changes. That took us down to now 1.5% if you look at the core inflation numbers. Very surprisingly, we didn't expect this, and neither did the Fed. That said, it seems like we've now passed the trough. We were down at 1.3% a few months ago, now 1.5%. And I think the combination of further strong economic activity and labor market activity, maybe a little more pass-through from higher commodity prices and a slightly weaker dollar, and then the cycling, the dropping out of past declines in prices in some individual categories, again, cell phone services in particular. The combination of that, I think, is going to push us somewhat higher. Our forecast here is similar to the Fed's, that we see higher inflation, but still below the target at the end of the year.
And
so
that's
1.8%.
And that's a global phenomenon, right? I mean, the ECB also has trouble hitting its target. Are the reasons the same?
I think the reasons are a little different. I mean, some are probably similar because, of course, there are some prices that are set in global markets. But I think the key distinction between the ECB and the Fed is that unemployment in Europe is still close to 9% on average. And so from that perspective, it's not really surprising that you have very low inflation if there is still a lot of slack in the labor market. The puzzle, similarly in the U.S., we had very low inflation in 2010, 11, 12. Not a surprise because you also had a very weak labor market that was only starting to get better. And Europe, I think, is more in that sort of situation. As time passes, I would expect stronger activity in Europe to also put some upward pressure on inflation. But again, the Phillips curve is flat, so lots of other factors will matter as well.
How do you see, just to juxtapose the two, the European economy and its path compared to the U.S. economy?
I think from a growth perspective, it's quite synchronized. Growth is not very different in the two economies. In fact, Europe, if anything, is growing even a little more quickly relative to potential, because potential is lower, demographics are worse, labor force is growing more slowly than in the U.S. So from a growth perspective, it's nuances. The big difference is that Europe is maybe 4 years behind the U.S. I mean, output troughed in the U.S. in early 2009, output troughed in Europe in 2013, and that's a simple way of dating it, but I think it gives you the right sort of sense of Europe being on the same broad macroeconomic path, but just with a 4-year delay.